Welcome back to Your Money, Your Call, the final segment. We've got a lot to do, so I'll tell you that I'm Mark Todd, he's Richard, he's Rudy. We'll get into it. We've got an email that we want to deal with first, and it's from David. And after mentioning XTB last week, I've been trying to understand the proposition for a retail investor. If I buy some of the bonds whose parent is Telstra, I understand I place a certain way in the risk structure compared to shareholders and holders of subordinated debt. Where does XTB or Theta Asset Management come into question? They don't seem to be a broker like CommSec or NabTrade or the exchange like the ASX. Are they more akin to an LIC? Looking at the trade history for the YTMTLS code, there appears to be a 13k units or 1.6 billion worth of transactions over the last 6 months. If this were a company, this would be too illiquid to invest in. Does this translate to exchange-traded bonds?
Okay, we're speed dating. This is a
We are
answer.
absolutely speed dating because
you're on the right track, Dave.
Because I've actually got, David, I've got the email in its entirety, which I will send to you on Monday, but I believe you've already run through to confirm. But regardless, we'll send you the email.
He's on the right track. So yeah, it's like a LIC, or it's more like an ETF. So we're not the exchange, we're not a broker. It is a investment on the exchange, like an ETF. Instead of a diversified ETF, there are 33 individual single bond ETFs. Second part of his question. Is the liquidity the same as a company liquidity? No, it's not. When there's a market maker and you have open-ended vehicles, the liquidity that's important, David, is what is the liquidity of the underlying bond or equities or gold, whatever it is, not the instrument on the ASX. So even if that number was zero traded and you wanted to buy $5 million tomorrow, well, Saturday or Monday, you can buy $5 million on Monday. So it's not like equities. It is like ETFs and other securities that have market makers.
And I think the market maker thing is something to emphasize in that respect.
Yeah. Yeah, and
you can always buy and always sell.
Yes,
basically the point.
Yeah, exactly. Yep. Subject to the underlying. Yep.
Subject to the underlying. Now, the other thing we wanted to bring up is you brought in a chart on asset performance, asset class performance. And Rudy, I think your asset class hasn't really performed that well.
But here's the point. You're right. But if this continues, then you will have at the end of the year a normal looking year with all the volatility and pain and everything in between.
Yeah.
Because if this market rallies, let's say 3-4% in year end, the total return of the market will be close to 7-8%. Yeah?
Does that include the dividends?
Year. Yeah. That's a normal year.
So with dividends, you get 7 or 8%, and you get a lot of headaches.
Yes, but I mean that's equities, I mean.
Yeah, that's what you love. We love the headaches.
That's the way it is.
And so the way equities people would say to you, if you bought at 4,900 in the index, you probably would have made a lot more.
Yep, sure.
Yep.
Now, talk me through this. What am I looking at?
Yeah, so look, and to be fair to Rudy, this is a one-year chart. You don't do one-year charts, but I put this chart up to actually make a point. Last time I was here, I brought you a 15-year chart, which showed equities coming out on top as they were over 15 years.
I can't remember the last time I met you.
That's right.
So keep going. Okay, it's an age thing.
So the 15-year chart, equities did 9.5% total returns, bonds were 7.5%, and hybrids were 6.5%, and their volatility was 15, 2.5, 6.5. The point there was senior bonds tell a good story over the long term. So too do equities. But this chart, I wanted to zero in on this chart because it does actually show the stability. The point I was trying to make in our earlier chart was how stable are some of these securities. So if you look at that chart and the very straight line in the bottom one, that's your senior floating rate bond, in fact 6 of them from a range of different banks, and you see how stable that is in terms of performance. It has even outperformed the hybrid portfolio, which obviously has suffered because the equities have suffered, and it has been a pretty bad year for equities.
Which is the green line? Is that the hybrid?
The top line, the green line, which is teal, by the way. That's the colour, and aubergine is...
Oh, teal. I beg your pardon.
New colours.
So what's the green line?
That is the total returns of the senior bond XTBs, which are...
Okay. And then there's a line below it?
That straight line is the floating rate bonds, total returns.
And then the more volatile, they're about the same
That's the hybrids. That's 33 hybrids on the ASX.
Where's the equity market?
Equities in the top one, you can see equities going up and then down,
and
then up again. So I then got equities out of it to show you, well, senior bonds have got a story to tell, which is capital stability and good total returns. Even the floating rate ones, which generally have lower total returns, that's a story of utter capital stability.
Just a quick note on the senior bonds. One of the things to think about, folks, and this is not to take air out of the balloon of senior bonds, is that in a low interest rate environment, which it has been going forward, they are going to rally because they just offer, it's a normal yield curve. the longer I invest, the better the performance because it comes down. So people keep buying it, and that's just that's nothing bad. I mean, like I said,
that is what it is. Yeah.
it is what it is. You should have senior bonds. You should have safe assets that you can liquidate as much as you like. Now,